Welcome back to the Deep Dive. We're the place you come to get straight to the core of, well, the big ideas, the dense research, the really crucial works. We do the heavy lifting so you don't have to.
And today, we're tackling an absolute giant of investment philosophy, Philip A. Fisher.
That's right. His 1958 book, Common Stocks and Uncommon Profits. So, foundational stuff. Shaped people like Warren Buffett.
It really did. And if you're looking at today's market, all the ups and downs, and just craving a strategy that's, grounded long-term, this is it. Fisher wasn't about finding cheap stocks. He was searching for truly exceptional businesses.
Exactly. That's the core question, isn't it? What makes a truly successful investor different from, say, the average person just guessing?
And Fisher's answer was discipline. It was intelligent investing, focusing laser-like on finding those amazing companies.
And then, this is the hard part for many, having the patience to just hold them. Sometimes, like forever.
So our mission today really is to give you the shortcut, the core insights from this classic text, a kind of guide to quality investing.
Okay, let's dive in. The first concept is probably his most famous, maybe most revolutionary idea, even though it sounds a bit funny. He called it the Scuttlebutt Method.
Right, scuttlebutt. It's an old naval term, basically means gossip or rumor. But Fisher turned it into a serious investment tool. The idea is simple. The real story of a company, its health, its competitive edge, it's not in the glossy annual report.
No, it's out there on the street.
Exactly. You find it by talking to people who actually deal with the company day in, day out.
So you have to become like an investment detective. Put on the trench coat.
Sort of. It means you recognize that the official corporate line, the press releases, that's often just curated spin.
You need the nuance, the stuff they don't put in the report.
And this requires discipline. Fisher was really specific about who you needed to talk to. This isn't just, scanning headlines. It's actual field work.
Which feels almost countercultural now, right? Everything's instant data feeds.
Yeah.
But he gives 4 key sources. First one, customers. Seems obvious, but crucial.
Totally crucial. Are they actually happy? Do they come back? Would they recommend the product or service? Fisher got that a loyal customer base, that word-of-mouth marketing. That's a huge competitive advantage you can't easily see on a balance sheet.
Makes sense. Okay, then he flips it. Talks to suppliers. Why them?
Well, suppliers see the operational side. They know if the company pays its bills on time. Are they easy to work with? Or are they constantly changing orders, causing chaos?
Ah, so it's a window into management effectiveness. And maybe integrity, too.
Exactly. If they treat suppliers badly, it often signals deeper problems. Inefficiency, maybe just short-term thinking. A good company is usually a good partner.
Okay, number 3. This one sounds tough.
Yeah.
Competitors. You actually talk to the competition.
Yep. What do they honestly think? Where does this company excel? Where are its weaknesses?
Wow. So you're asking their rivals, where are they killing you?
Basically, if competitors even grudgingly admit respect for, say, their R&D or their sales team, that's a powerful signal. That speaks to a real durable advantage.
And the final source, former employees. Why did they leave? What's the real culture like?
This is the ultimate ground truth on leadership, isn't it? Financials might look great, but if everyone who leaves says it's a toxic place with high turnover...
That's a ticking time bomb for a long-term investor.
Absolutely. It's a major red flag no matter what the numbers say today.
So Scuttlebutt forces you away from just reacting to the ticker price towards building this solid analytical foundation based on, well, reality.
And once you have that street-level view, you need a way to structure it, to quantify it. And that's where Fisher's famous 15 points come in, his quality checklist.
Right, the framework for finding that long-term winner. He wasn't looking for a quick flip.
No, he talked about finding businesses worthy of, like, a marriage. You're in it for the long haul. So this checklist is rigorous. We can kind of boil down the 15 points into maybe 3 big themes: growth, business effectiveness, and the big one, integrity.
Okay, let's start with growth potential and innovation. This is where he's really focused on the future, right?
Absolutely, obsessed with it. First question, does the company have products or services with enough market potential for a sizable sales increase over several years, not just a little bump?
Is there room to actually grow significantly?
Right, a big runway. And crucially, is management determined to keep developing new things? New products, new processes to keep fueling that growth.
So not resting on their laurels.
Yeah.
Constantly innovating.
Exactly. Which leads to R&D effectiveness. How good are they at it? And Fisher added this interesting nuance. How effective is their R&D relative to their size?
Ah, so a smaller company that's punching above its weight in innovation is a really good sign.
It shows that drive, that potential for future leadership. They're investing smartly to stay ahead.
Okay, that makes sense. Moving to the next pillar, operational effectiveness. How well do they actually run the business day to day?
Yeah.
He asks, do they have an above-average sales organization?
Yeah, because a brilliant product that nobody buys is, well, useless from an investment standpoint. Fisher knew that exceptional returns need both innovation and the ability to sell it effectively. You need that sales engine humming.
And he looked at profit margins, naturally, wanted a worthwhile margin. But then he added that deeper question. What are they actively doing to maintain or even improve that margin?
Right. Today's margin is yesterday's news, in a way. It's the result of past actions. What matters is the strategy going forward. Are they optimizing? Cutting costs smartly without hurting quality? Those management decisions are key.
Okay, now the third pillar. You said it was the big one. Management integrity.
This was non-negotiable for Fisher. Unquestionable integrity, period.
Why so absolute on this?
Because if management is dishonest, everything else is built on sand. They can fake earnings, they can mislead you, they can dilute your ownership to line their own pockets.
So all that scuttlebutt, all the analysis of the 15 points, it could all be based on lies if the integrity isn't there.
Precisely. All your hard work is worthless. If you plan to hold a stock for potentially decades, like Fisher advocated, you have to trust the people at the helm. Integrity is the bedrock.
Okay, so let's say you've done the detective work, the scuttlebutt. You've checked the boxes on the quality checklist, especially integrity. You found one. What's next? Fisher's answer seems almost shockingly simple today. We just hold it.
Right. His whole philosophy on the long-term mentality, think like a part owner of the business, not just a stock trader.
And get spooked by market noise.
Exactly. Short-term panic, short-term euphoria. It's irrelevant if the underlying business quality is still strong. You bought a great company, you don't sell it because the market's having a bad week.
Which brings us to that really famous quote. It sounds so radical now. If the job has been correctly done when a common stock is purchased, the time to sell it is almost never.
Almost never. That qualifier is key. He wasn't totally naive. He knew you couldn't hold literally everything forever. But the bar for selling, incredibly high. It forces you to be so careful when you buy in the first place.
But almost never. I mean, in today's world, with tax considerations, maybe needing liquidity, it feels really strict. Did he allow for any reasons to sell?
He did, but they were very specific, very rational, and none of them were about market timing or needing cash for something else. There were only 3 legitimate reasons.
Okay, what are they? First one.
First, you realize you made a mistake in your initial analysis. Maybe new info comes out, maybe from more scuttlebutt down the line, showing you were wrong about the management or the competitive edge.
So admit the error, cut your losses. Makes sense.
Humility is key there. Second reason, the company fundamentally changes for the worse.
Okay, give me an example. Like, say, that innovative tech company we talked about. Visionary CEO leaves, new management cuts R&D, the magic starts to fade.
That's it, exactly. The business you bought doesn't really exist anymore. It's become something lesser. The quality has deteriorated. That justifies a sale, even if the stock price hasn't crashed yet. The reason you bought is gone.
Got it. And the third reason, the one with the really high bar.
You find a significantly better investment opportunity. And significantly is the key word.
How much better?
So much better that it clearly outweighs the transaction costs, the capital gains taxes you'll trigger, and importantly, the compounding you lose by selling the great company you already own. It should be a rare event.
Wow. So those 3 reasons basically eliminate almost all the common reasons people sell today, market drops, taking profits just because following the herd.
It forces you to ignore the noise and focus purely on the underlying business and your original thesis. It's about rationality over emotion.
So let's bring this all together for you, the listener, wrestling with information overload, constant market chatter. What's the big takeaway here? These ideas are, what, over 60 years old?
But incredibly relevant, timeless, really. They push us beyond just looking at numbers on a screen. It's a fundamental mindset shift. Stop thinking like a stock speculator.
And start thinking like a business owner.
Exactly.
Okay, let's recap those core takeaways. First, be a detective. Use that scuttlebutt method. Talk to people. Get the real story. Second, use a quality filter. Those 15 points boil down to growth, effectiveness, and absolutely integrity. That's your framework for judging long-term quality.
Third, think long-term. Once you've done the homework,
Trust the process.
Mm-hmm.
Let compounding work its magic. Ignore the daily noise.
And underpinning it all, focus relentlessly on quality. Find businesses with real competitive advantages, real innovation, and management you'd trust with your own money. Because fundamentally, that's what you're doing.
Yeah, the price you pay is important, but Fisher argued it's secondary to the quality of what you're actually buying.
He really believed that. Remember, behind every ticker symbol, there's a real business with real people.
And your analysis needs to reflect that reality. It needs to be active, deep, fundamental.
Especially today when data is everywhere, but genuine insight, that's much harder to find.
Okay, here's a final thought to leave you with, building on that idea. What if you applied Fisher's Scuttlebutt Method? Not to a stock, but to yourself.
Oh, interesting.
Yeah, what if you metaphorically talk to your customers, clients, colleagues, your suppliers, mentors, support network, your competitors, peers in your field, even former employees, people who knew you in past roles? What surprising, maybe uncomfortable, but necessary insights might you gain about your own strengths and vulnerabilities?
That's powerful. Applying that kind of rigorous external analysis to your own path, whether it's your career or even your own business, it takes discipline.
It really does. Well, thank you for joining us on this deep dive into Philip Fisher's wisdom. We hope it helps you think more deeply, research more thoroughly, and maybe find some truly uncommon profits along the way.
Until next time, keep digging.